Hi, this is Mike. I hope you are having a good time. And here is the latest news and what is likely to happen with the market. The performance of all US stocks in September was down significantly. The Nasdaq in particular was down over 10%. It's not just the stock market. There is a lot of bad news coming out right now, and there are rumors going around in the community that Credit Suisse is about to go bankrupt. I'm telling you clearly, Credit Suisse will not go bankrupt. Credit rating at the operating level is higher than Deutsche's and others. Credit Suisse's funding is stable. Credit Suisse's problem is that it has been too inclined to do business in China. In recent years, the Chinese government's change of heart has dried up the online billionaires, and Credit Suisse, which had them as customers, lost a pillar of its growth strategy. Credit Suisse should cut off the investment banking business and bring back the First Boston name, which is primarily an advisory brand name, not a capital-intensive trading brand name. I think that by keeping it small, it will attract buyers. Suisse's stocks plunged after the Lehman shock. It recovered from that once, but the chart has been on a steady decline since then. Now the stock price is finally at $3, which is completely different from the time of the Lehman shock. Lehman was not a bank. Credit Suisse is a bank and has core deposits. This is the big difference. The fact that these rumors are running is in itself a buy for US stocks. It's a gift from God. This is the end of the tightening. I'm sure there are some people out there who are watching the news and they are saying that Credit Suisse is on tenterhooks, and that means that the Fed has to be very careful about what they do. It means that the pace of rate hikes will slow down, and if that's not positive for US stocks, then what is? Just buy. Bad news is good news. The worse the news, better news for stocks. Just buy an index ETF that buys the entire US stock market. The time is now. This is a famous American saying. A bull market is born in pessimism, grows up in skepticism, matures in optimism, and disappears in happiness. Now the market is either optimistic or pessimistic, and of course it is pessimistic. We are in the position of the starting point of the long-term bull market, the first floor of the market. That's exactly where we are right now. So the following order is also very important. First, the long-short interest rate differential goes to zero, then comes the big bear market, and then comes the recession. When the recession actually comes, stock prices will go up. The gap between long and short-term interest rates has already reached zero. Of course, a big bear market is coming. What's coming next is a recession. But look here, we have already lost $36 trillion in global financial markets since the beginning of the year. And there were headlines like this one: stocks end month with worst losing streak in 20 years. All three major indexes experienced their worst first 9 months of a calendar year since 2002. Normally, these headlines are a buy. If you don't buy now, then when are you going to buy? Have you ever heard of the saying, "The time is not yet ripe"? In the early stages of a down market, investors continue to maintain an optimistic stance, and when the mass market drops significantly in terms of price, it is human nature to think that since it has dropped so far, it will be fine from now on. However, there are two factors involved in a market adjustment: price range and daily pattern. The daily pattern refers to the elapsed time. It's not enough for the market to be undervalued in order for it to come back up. A certain amount of time is necessary for that. In other words, a market that has become popular and has been played up by investors has exhausted its nutrition. Even if they decide to come back out again soon, they will not have enough energy built up so they are likely to fall back down again, sluggishly. There are early times in a market's life when the market suddenly rallies and makes you think, look, it's alright. This is called a bullish trap. Bullish traps are nothing more than so-called deceptions. If you carelessly fall for this trick, the market will immediately start falling again, and you will end up making your losses even bigger than they already were in the bear market. Repeatedly falling for the trick makes investors more cautious, and they will swear that they won't waste their money anymore. This leads to fewer participants in the market, which naturally leads to lower trading volume. In other words, they refrain from buying new stocks, but hold on to some of their assets. Even at this stage, the market has not yet reached a major bottom. In other words, the situation where no one wants to sell is not yet a breakout. At this point, the real economy finally catches up with the decline in stock prices, and economic indicators are starting to worsen. It may take up to a year after stock prices enter a bear market for economic indicators to start deteriorating in this way. Examples of specific indicators that the economy is deteriorating include a decline in equipment utilization rates, a slump in industrial production, a drop in automobile sales, a decline in housing market, a rise in the unemployment rate, and an increase in bankruptcies. Furthermore, if the recession becomes severe enough to shake the financial system itself, the central bank can stimulate the economy by cutting interest rates and provide liquidity to the markets. When a recession becomes severe, companies and individuals will seek to consolidate their debts and accumulate as much cash as possible for fear of bankruptcy or layoffs. In the case of individual investors, they will quickly dispose of their remaining holdings in order to sever themselves from the stock market. By that time, their assets have been reduced considerably by the bear market. At this point, there are no more holdings to sell, so there is no selling pressure to return to the market. As the recession drags on, investors gradually become extremely risk-sensitive and allergic to the possibility of losing even a little money. In other words, they become extremely conservative. Of course, without a shred of enthusiasm, the investor simply exhibits a shrinking attitude. No one is worried about missing the market, and in fact, many investors are withdrawing from investing at all. The stock market will be neglected by everyone. By that time, stock prices have fallen so low that stock yields are outpacing bond yields. Business is extremely thin and the media doesn't report on stock market events, so no one notices when the market quietly reverses. But before you know it, the number of stocks at new lows is decreasing, and the volatility of the market begins to increase. This is when stock prices quietly bottom out. However, most investors have run out of money to begin with, so they don't even think of taking advantage of a market reversal. The news surrounding the economy should still be all bad at that point. So again, there is foresight in the stock market, so even if the economic indicators are still bad, the stock market will bottom out one step ahead of the market. Bear markets can sometimes last up to 3 years. The longer the bear market lasts, the more energy is accumulated, so the next bull market will be a strong one. In summary, in the early stages of a bear market, many investors are still thinking that stock prices will rise soon. And as long as they think that, the stock price will still go down. Then again and again, we get caught in the bull trap, and investors pass through bearishness and become indifferent. Since the beginning of this year, it has been a bull trap over and over again. I think many investors have been caught in it. And right now, there are a lot of very pessimistic investors and indifferent investors. If you liked the video and want to watch the next one, be sure to subscribe to our channel and smash that like button. If you have any questions or suggestions, post them in the comments below.